capital expenditure is the purchase of a fixed asset. So that's when you go ahead and buy a piece of equipment or a factory or a building, and typically, that expenditure takes place at the beginning of a project. But accounting rules are such that the costs, the cash flow associated with that, cannot be taken as an expense when you make the purchase. So the idea is that you're buying a long-term fixed asset that's going to be productive. So accounting rules say, hey, even though you just spent $1 million on this piece of equipment, you don't get to take it as an expense. Instead, some or all of that expenditure can be taken as a non-cash expense. So you actually write it into your income statement, but no cash is paid out because it's paid out when you bought the piece of equipment or the building or the fixed asset. And you take it as expense over some period of time. And that's depreciation. Take that every year. Remember that from the net income statement. How do we come up with the depreciation that can be taken each year? They're determined by rules, and we're going to go over some of those. Before we get into the specific rules, an important thing to keep in mind is what the firm's objective is. They want to take as much depreciation as they can as quickly as possible. And here's why. So it's a non-cash expense. So you just write it into the income statement. It lowers income because remember, income is revenues minus cost minus depreciation. So the bigger depreciation, bigger the negative effect on the income statement. However, no cash flows are actually paid out at that time associated with that depreciation expense. However, it reduces taxable income, which reduces the taxes that are paid, and that's a real cash flow. That is a true cash flow. That is the amount of a check that gets written to the government. So if a big depreciation expense lowers taxes, then it increases the net cash flow to the firm, and that creates real value. So the more depreciation we can take, the more cash we get to keep. And we know from time value of money, the sooner we can have that, the better. So if I'm going to, if I have a situation where I can take a write down that's going to, save me taxes, I'd rather save them today than in a year, and I'd rather save them in a year than in 5 years. This is called the depreciation tax shield. And what it's equal to is the amount of taxes that you don't pay because of depreciation, and it's simply the amount of depreciation. So that's what you get to lower your taxable. That's what you don't have to compute taxes on. You don't have to pay taxes on because you're subtracting it out times the corporate tax rate. So again, remember that the objective of a financial manager is within the rules to be able to take as much depreciation as quickly as possible. So there's two common ways that we're going to address in this class. One is straight line, and here you have a certain amount of depreciation that you get to take, and you spread it evenly out over a given period of time. And this is used a lot for financial reporting because it's very straightforward, easy to comprehend. The second is accelerated depreciation, where you've got some total amount of depreciation that you get to take, and the rules allow you to take more of it earlier in the life of the asset. And so this is most often used for tax reporting because, as we said before, you take a lot of depreciation early on, so you pay less in taxes early on, you increase your cash flow early on, and that enhances value. So how do we compute straight line depreciation? So in each year where depreciation is relevant, let me pull everything up. It's the investment, which is the amount that's initially spent on a plant or a piece of equipment or that fixed asset, and it's a positive number. So if we spend $1 million on a piece of equipment, our investment is $1 million. We subtract out the amount that an asset's depreciated to. That number is based on how much it will be worth at kind of the end of the depreciable life, which I'll talk about in a minute, with accounting rules. So accountants figure that out, and that total difference, the investment minus the amount that's depreciated to, that's the total depreciation expense that gets to be taken, and it's spread out over the depreciable life. So here we have the depreciable life. So the investment minus the amount it's depreciated to, that's the total amount, and then it just gets spread evenly out over a number of years. Where does that come from? It's a combination of the estimated productive life and accounting rules. Sometimes it's also called the useful life or the tax life. So you basically have the total amount of depreciation you get to take, and you split it evenly up over a certain number of years. The accelerated depreciation that we're going to look at is modified accelerated cost recovery system, or MACRS. And the numbers that MACRS generates are often not as nice as the numbers that nice and round as the numbers in Straightline, but the methodology is very straightforward. In each year, it's equal to the amount of the investment. So again, the $1 million we paid for the equipment or whatever it is, times a rate that's given in a schedule that the IRS puts out for that particular year of the asset's life. And so with Straightline, you can sometimes depreciate the asset to some number that's not zero. Here, it's always just the investment times the rate. And where does the rate come from? Like I said, it comes from a schedule. And so there's different schedules, like a 3-year schedule, a 5-year, a 10-year. And depending on the kind of asset and kind of its estimated life, it gets determined as to which schedule is appropriate. And in this class, you get told, kind of the relevant schedule, but that's one of a accountant's duties would be to figure out, for a particular asset, how it would be classified and which IRS schedule would be appropriate. There's something called the mid-year convention, and what that means is that in this class, for example, we're going to look a lot at the 3-year schedule. So the name of the schedule is the 3-year schedule, but there's actually going to be 4 years of depreciation. So whatever schedule you're using, the 5-year schedule, if you were, there'd be 6 years of depreciation. And the reason is because we assume that no matter when the asset is purchased during the year, so here's the year, and whether it's bought at January 1st or December 31st, for depreciation purposes, we assume it's bought in the middle of the year. So here you have 0, 1, 2, 3, and 4. And so if this is a 3-year schedule, we would be depreciating over 36 months. So you'd have 6 months here, 12 months in year 2, 12 months in year 3, and then 6 months in year 4. And so you can see there's 4 years when depreciation takes place. 6 months in year 1, 12 in year 2, 12 in year 3, and 6 in year 4. So we'll take depreciation on our income statement in years 1, 2, 3, and 4. So the idea is just you don't need to know why the mid-year. Just oftentimes students see, oh, look, there's a 3-year schedule, but I have 4 numbers, and I have to figure out depreciation in year 4. I'm confused. Don't be. 3-year schedule, 4 years of depreciation. A couple of notes: you don't take depreciation immediately. You don't take it at time 0. It starts in the first year, in year 1. If you use Straightline, you can take a depreciation expense each year during the useful life. So if we're, our equipment that we're buying for $1 million and we're depreciating it over a depreciable life of 4 years, you get to take an expense in year 1, year 2, year 3, year 4, but not 5, 6, 7, 8, 9. And there's nothing wrong with with using an asset, having it be part of a project and existing and operating after all the depreciation expense has been taken. In fact, that's the accountant's goal, because they want to remember take as much depreciation as early as possible. With MACRS, it's just from the schedule. So again, if you're using a 3-year schedule, as you'll see in an example, you'll have depreciation for the first 4 years, but nothing after that. So let's take a look at a couple of examples. So here we're going to buy equipment for $110,000. Tax rate's 40%, and we want to know what the depreciation expense is going to be for each year for 7 years. So at time 0, 1, 2, 3, 4, 5, 6, 7. We just want to know the expense, so the tax rate's actually irrelevant. And so let's go ahead and look. So the first thing we'll look at is Straightline depreciated to $17,000 over a 6-year useful life. And so here I laid out a table, and you can see there's no depreciation in year 0. Years 1 through 6, each year of the depreciable life are the same. It's the investment which is 110,000 minus 17,000, which gives us $93,000 total. $93,000 total that we get to take as depreciation, and we're doing it over a 6-year life, so divide by 6, and each year for 6 years we get to take $15,500. Then we get to year 7. We're still running this project, we still have this equipment, but we are past the depreciable life, and so the depreciation is 0. Example 2 is if we have makers, and again we're using a 3-year schedule, so therefore we'll have depreciation for 4 years, 1, 2, 3, and 4, and the rates are 33.33%, 44.44%, 14.82%, and 7.41%. And all we do to get the depreciation in each of these years is some multiplication. So again, no depreciation in year 0. Year 1, we have a rate, multiply it by 110,000, 36,663. Year 2, that's our biggest. We get to take, almost half the depreciation just in that 1 year, 48,884. Year 3 and year 4, do your multiplication, and then notice no rates for 5, 6, and 7 because it's a 3-year schedule, so there's 4 years of depreciation. No depreciation years 5, 6, and 7.